He's free. He's in.
We got a whole new ball game, Matt.
"29-yard touchdown run. Ben Carlson, 21st touchdown of this, his junior season." And you
Welcome back to Ask the Compound. We're coming to you one day early for a holiday schedule, but that's okay. Everyone in the live chat is here. We appreciate it. On today's show, a bunch of good questions. The optimal savings rate for a Coast Fire retirement. I feel like Coast Fire is on our top list of active questions this year. Is Boomer Candy a bond replacement? We'll tell you what Boomer Candy is. How to hedge against higher rates in the housing market. How to handle a short-term housing situation where you're forced to sell. This is for our active servicemen and women of the United States. We appreciate you. How an 18-year-old can build wealth to retire comfortably. We have an 18-year-old listener who asked a great question. Remember, our email here, askthecompoundshow@gmail.com. Today's show brought to you by Rocket Money, my favorite personal finance app. The holidays are here, and it's never been easier to spend money without consequences, right? You have the Apple Pay, you have Amazon Buy Now, you just tap that credit card. I feel like it's easier than ever to overspend in the holidays. Everyone's spending like crazy. And I think Rocket Money can help. Rocket Money is a personal finance app that helps find and cancel unwanted subscriptions, monitors your spending, and helps you lower your bills so you can grow your savings. Rocket Money can help you track how much your spending is up month over month so you know how much discretionary spending you're doing for the holidays. We have like 4 boxes showing up a day at our house for Christmas presents. Rocket Money allows me to view how much money my wife is spending this holiday season and all that stuff. You can create a personalized budget, include like a side pocket for Christmas gifts and such. You just set your monthly income. They will track your regular monthly bills and expenses. It's really easy. Rocket Money has over 5 million users and saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all the app's features and premiums. Cancel your unwanted subscriptions and reach your financial goals faster with Rocket Money. Go to rocketmoney.com/ATC today to learn more. rocketmoney.com/ATC to learn more.
Yeah, I already got that Rocket Money email that said your spending is up, blah, blah, blah % over the last month.
Massively, right?
Yeah.
Yes, I think
that's going to happen.
Yeah, we don't cut back in this country.
Speaking of good holiday gifts, though, there's still time. I looked just before the show on Amazon.
Oh.
Our very own Ben Carlson's book, Solid. Look how thin that is. Look how quick of a read that is. If you have someone in your life you want to get something practical for, kids, grandkids, this is a good gift.
All right, thanks for the plug.
Yeah, you can have it by Saturday.
Is it really? Okay.
Yeah, that's what it says. So, yeah.
All right. What's your question?
Okay, up first today we have a question from Chad. I have a quick question about the ideal retirement saving percentage per year. I always see 20 to 30% of your pre-tax income is great, but I was curious if this calculation changes with post-tax accounts. I'm pushing all of my retirement savings into a Roth 401k and Roth IRA. Since these are all post-tax, should I aim for a lower percentage? I haven't found a great answer online and like having the annual goal so I don't just save forever.
Okay, we've gotten a lot of questions over the years on the ideal savings rate, but I feel like this one does the job of going a little bit further, which I like. Chad is basically asking, can I front load a bunch of Roth accounts for retirement with a healthy 20 to 30% savings rate and then cut back a little? So this is the Coast Fire thing, right? Coast Fire is one we've been getting a lot of questions about. It's essentially the idea that you front load a lot of your savings, then you reach a point where you know that you can either live off of that money or it can grow enough where by retirement age you'll be set and you can cut back your saving now, so you can either cut back on your work so your income's lower, or you're going to spend more and not save as much, right? So you're coasting and letting the compound interest do the heavy lifting for you. The other thing Chad's doing here is paying his taxes up front, so he's following the Bill Sweet, everything in a Roth. Most people don't think about this retirement savings question in terms of after-tax dollars, right? And that's what matters, is the net amount you're willing to take home. So paying the taxes up front does change the equation. You know this is the pile of money you're going to have, and like it, just from a complication perspective, it makes your life a lot easier because there's ways to spend your money tax efficiently and tax aware in retirement while you're going to pay the taxes, but it's not as bad. But with a Roth, it just takes away a lot of those questions. So I can't answer whether a 20 to 30% savings rate is high, but that's a phenomenal savings rate in my book. That's probably around where mine hovers each year. And I've actually run the numbers before to take, here's my portfolio today. If I put a conservative growth rate on it, it grows 6% a year, 7% a year for the next 20 years. What's my co-stability? Can I trademark that one? My co-stability? I don't know. I'm probably pretty good at it anyway, but I keep saving regardless. And I have dialed back in recent years because of this, because I front-loaded a lot of my savings in 20s and 30s. So I get the idea. But the spending is the key here, of course, when figuring out, like, is this going to be enough for retirement? Like, the beauty of a high savings rate, in my book, is not only that it gives you a margin of safety now, but it means you have to replace less income in retirement, right? If you're saving 30% of your income now, you're not going to have to spend as much because you don't spend as much now. So I think retirement planning starts with the savings rate, but it ends with the spending rate in retirement. So you can make an estimate of how much you're going to spend, figure out if that's a reasonable percentage of your portfolio, create some return ranges to set reasonable expectations, and then like make course corrections along the way. That's how you retirement plan. And I think if you're saving 20 to 30% in all Roth dollars, you're in a very good place. So you want to turn down your savings rate after filling out those buckets for a number of years, that makes total sense to me. And then guess what? If returns are terrible for the next 5 to 7 years and you have to crank those savings back up, you can do it, but you're in a good place now. And I think a rich life to me is about striking the balance between like feeling like you're saving too much at times and feeling like you're spending too much at times, and kind of going back and forth between those two things. They should both make you a little uncomfortable at different points of your life.
So do you have to factor in how much, you're up or down that year, Viv? You put 30% away, but you lose half of it.
Yeah, of course. Yeah, that's a course correction. So you make some estimates, and for some people, it's
not asking for myself. Not asking.
Yeah,
for
but
myself.
I mean, we've seen a number of baby boomers, like they take the expectation of how many people are going to retire based on their age and based on when they typically retire, and we've had 2 to 3 million baby boomers retire early since the pandemic. Some of that was pandemic related, but some of it was also, hey, whoa, I'm doing way better than I thought I would. I'm going to retire. And then yeah, if we go through a lost decade here in the coming years, then people are going to have to either cut back or go back to work or change their assumptions for retirement. But that's the whole point, is that you have to be able to make some course corrections along the way. But I mean, Chad's doing great, obviously. 30% a year all in a Roth, you're good.
Yeah, good job, Chad.
Keep coasting. All right, another question.
Okay, up next we have a question from Cornholio on Twitter. That's a Beavis and Butthead reference,
That is
right?
a Beavis and Butthead.
Okay.
Yes.
I never really watched that, but I know that reference.
It was when I was in, I don't know, 5th or 6th grade. Beavis and Butthead was huge. So I was a Beavis and Butthead guy when I got home from school.
Okay.
Definitely.
Okay. Got it. I was a Doug guy. Okay. Up next we have, would you or could you classify Boomer Candy ETFs with options income as a stand-in for the fixed income side of your portfolio? Or does it have to be bonds?
All right. So I think it was Bloomberg's Eric Balchunas who coined this for a Wall Street Journal article. And they talk about Boomer Candy is high income, but you still want to be part of the stock market, right? It's like having a little bit of having your cake and eating it too. So option-based income strategies have exploded in recent years. It used to be where you couldn't really do these in ETFs quite as easily, and now you can.
And the most common strategy is they're selling calls.
Selling calls. So
Okay.
so JEPI is a JP Morgan Premium Equity Income ETF that sells call options on high quality stocks. It's the largest actively managed ETF. Last time I checked, like 38 billion. So these things are very popular. There's all kinds of funds now that will sell options on individual stocks or stock indices to create income, and that income is definitely higher than what you get in a high quality bond fund. We've talked about call options in the past, but good for a review. So a call option gives you the option gives you the obligation to sell a security at a predetermined price, and in the trading off for that is that you get income now. So you're giving up some of the upside for exchange for income if that stock gets called away at a specific. So you're kind of capping your upside, right? I'm buying the stock at 15. I'm going to sell a call option to sell it at 20. If it hits 20, the person who you sold that option to has the ability to buy it, but you've got the income in the meantime. So right, if you get $2 of income, now that adds to your return. So the difference is, $7 that you made on the stock or whatever. So and that income will change based on prevailing rates, the level of volatility, level of borrowing rates. You can earn higher premiums on higher volatile securities. So a call option on the NASDAQ 100 should have higher income than a call option on the S&P 500. call option on an individual stock like Tesla should have way higher income than both of those.
There's
right?
something that feels so good about selling a call and getting that premium, but every time they get called away from me. So it's like I usually end up. I had like Rocket Lab, get called away. I've had several stocks that just soared after get called away.
And that's you'll get more income on stocks like that, but because they have the ability to go up so fast, you get called away, and that's the point. You're capping your upside, but you get paid for it. So the way that these strategies typically work, not always, is in a rip-roaring bull market. So in a big up year like 2023 and 2024, these strategies will tend to underperform because your stocks are up a lot. You're getting called away. They tend to outperform in down or sideways markets, right? Because in a bear market, your stocks aren't going to get called away, and you're still going to get that income as a buffer. So your stocks those strategies tend to do better. And in a sideways market, you're still earning the income and maybe not getting called away. So I guess the way that many investors look at this is that they don't care about the total return. They care about just the income. So I think these strategies can have a place in a portfolio, but I look at them more as a hybrid strategy, kind of like dividend stocks or convertibles or high yield bonds, where there is still some equity and volatility risk to consider, even though they're paying high income. And the way that I look at it is higher yields almost always come with higher risk, right? These are far more volatile than bonds. Bonds provide more than just income, too. They are a volatility protector. They protect against deflation or disinflation when rates fall. And then they're emotional hedge against the craziness of the stock market. You don't get quite as much craziness with a call option strategy, but you still get a little bit of it. You're not immune to losses in these. So I think if you're more on the aggressive side of the risk spectrum and want to earn some income but think bonds are too boring, I think you can take a piece of your equity allocation and a piece of your fixed income allocation and have it be this in like the hybrid middle ground. But I do not think of them as a bond replacement, more as a bond complement, where you want different sources of income, right? This is going to give you a little more upside, bang for your buck, than bonds, but not protect you as much on the downside as bonds will. So again, it's an income complement that straddles the equity and fixed income worlds.
So what about a buffered ETF? Would that be more analogous to a bond?
I think the buffer ETF is probably similar to an option strategy, but you have more defined rules in place in terms of you can cap the upside and the downside, and you probably know a little bit more what you're going to get out of a buffered ETF. But that's another option strategy that I think, yes, kind of straddles both worlds.
Okay.
But probably, yeah, you're right. Probably a little more conservative, depending on how you use it. There's some that are more aggressive and some that are more conservative. But anytime I hear the term bond replacement, that's a red flag to me, because there's almost always more risk with those types of strategies. People were looking for bond replacements when rates were really low. Now they're looking when rates are high, they want higher rates. So I don't think you can ever call them bond replacements, but I do think that they're bond complements.
After losing a bunch of money in TLT and stuff like that, bonds are dead to me. I gotta be honest. They're dead to me for now.
Duncan, you have to think about the time horizon. A 30-year bond, that's like a 20 to 30-year bond is a long time horizon, right?
True.
So it's the duration mismatch, right? You were buying a bond to hedge for the recession in 6 months that didn't come, but that bond is a 20, 30-year duration. So if that recession didn't come to fruition, guess what? Those bonds could get hammered in the meantime because they're such a long-term asset.
Yeah, I'll take my chances.
All right. Next question.
Okay, up next, we have a question from Alex. You answered my question about early mortgage payments versus investing in the stock market last year. Ben's recommendation to pile more excess savings into equities instead of mortgage paydown was a great reminder to stay on the path. I'm now faced with another big question: how to hedge against rising/prolonged rates. Specifically, I'm heavily invested in real estate, even more since the previous question, and want to hedge my portfolio. What's the best hedge to hold for several years, considering I'll be negatively affected by high or rising rates on long bonds and mortgage rates? I've looked at holding short bonds like SHY, inverse long bonds, and interest rate hedges. However, none seem effective for simultaneously holding and hedging.
See, this seems like a question you would ask potentially.
Yeah.
Right?
Yeah.
And I guess the problem here is higher borrowing costs are making it more painful to invest in real estate right now. I guess my biggest concern with this question is that you're making an implicit bet on interest rates. And also, I don't remember telling them this before about putting money into stocks versus paying down the mortgage, but I think Alex is a younger guy, and that's my point was, what's the point of having all that money tied up into your home? I think that was kind of my selling point there. But I guess he seems really certain that high rates or rising rates are here to stay. And they might be, but I don't know that for sure. I guess it depends on how you're borrowing money too. Like, are you worried about adjustable rate mortgages? Because that makes sense in terms of hedging to me. But if you have a fixed rate mortgage, that's your hedge, right? You don't have to worry about it. Rates go higher and your rate stays the same. Rates go lower and now you can refinance. So I'm assuming Alex bought some properties. Maybe he took some arms out under the assumption that rates would fall, but they didn't. So how do you hedge that? Well, the other side of higher borrowing costs are higher yields on fixed income. So I don't know, you could buy some mortgage bonds with higher yields right now. If rates keep rising, that impacts prices, but then yields are higher going forward. We don't really have all the information here for exactly what he's trying to hedge, but it might not be what he wants to hear. But I guess if you're really that concerned about higher rates on real estate holdings, maybe the answer is to sell some real estate, right? If you have to hedge something, the simplest hedge is often just selling. Like this, whenever people talk about hedging the stock market, the simplest strategy instead of buying an inverse bear fund or something or a tail risk strategy is just to hold more cash or bonds, right? It's not to try to find a hedge. So I'm really not a huge fan of hedging. Now in real estate, you could say, well, listen, I have to pay taxes. There's frictions involved with buying and selling a home. I get that. But if you're that worried about real estate and rising rates and what it'll do, maybe you're holding too much real estate. So I think the best hedges in life when it comes to money tend to be diversification and a high savings rate and some liquid cash-like reserves. And I've just learned throughout my career that trying to predict the direction of rates is almost impossible. And even the smartest people in the markets cannot do it. So I don't think that's a game that you want to play on a consistent basis, especially over the short term, trying to figure out that direction of rates. I'm just not that comfortable with that. So I guess I would need more information on what you're trying to do here. But if you're that worried about real estate, maybe you have too much in your portfolio, and that's a problem.
I mean, sounds like an enviable problem, right? Having too much real estate in this market.
Not bad, but I just worry about it. You think rates are, it seems like you could also be dropping money on these hedges for no good reason. The simplest one that he mentioned here would probably be short-term bonds, I guess. But I don't think there's an easy hedge for this kind of thing.
Yeah, this sounds like a key difference too in investing in real estate and buying a home to live in, right? Because you don't really care what happens to the price of the house after you buy it. If you're planning on living there for a long time,
no, you
right?
probably
it doesn't really matter.
Shouldn't. And the other thing is that, I think sometimes investors get a little too in their heads thinking that they're like a hedge fund, right? And trying to hedge out all these different idiosyncratic risks. And I don't know. Sometimes the best hedge is just the ability to ignore everything that's going on and extend your time horizon.
Someone in the chat says, why does value keep getting killed? I have this question too. My mid-cap value ETF it's been awful. What's going on?
Tech stocks, growth stocks, that's all anyone wants to own these days. And they're the best companies. It's not going to be here forever, I don't think, but those are just the best companies now. And the value stocks are not. No one wants to own those. I can't believe how long it's gone on, frankly. But when I was coming up, value stocks were the only thing anyone wanted to own. Not anymore.
Yeah, very out of favor.
All right.
Okay.
Next question.
We got an interesting one here. I'm a Marine Corps infantry veteran, and my wife is now an Air Force officer. Struck gold. We got married and bought a home in 2020 at 2.4%. After 3 years, we were forced to sell due to military orders changing, but luckily the home had appreciated 25%. However, we're now locked into what I think is an overheated market at 6.25%. We have orders coming up again and are struggling with flipping back and forth between buying and selling homes, renting out the home we own, or just calling it quits and selling and renting ourselves until she's out of the military. Any advice on forced timing? I didn't think about this really, but I mean, so do most people in the military just rent then? Because that would be kind of untenable to every couple of years be selling a house.
I've heard this too, that, and sometimes you might get some help, but I do love that we have so many servicemen and women that listen to the show and ask questions, and many of them have their finances in order and ask really good questions. So my initial thought when reading this question was, this is a perfect example of not everyone needs to own a home. And I feel like it's kind of taboo in America to even say that, because everyone thinks that that's just what you need to do. You need to own a home. And so I understand why they wanted to buy a house in 2020, especially with rates that low. And a lot of times armed service members get even a lower rate through some of their places that they can borrow through. There's like a veteran discount kind of, or not a veteran, but I guess a serviceman discount. But we live in a different housing market now, right? One of the biggest benefits of not owning a home is the fact that it gives you more flexibility. So with your current lifestyle, that could require you to change, where you live every few years. If your military were to change, now is not a great time to be constantly buying and selling homes, right? The first 5 to 10 years of owning your home, most of the money goes to interest, not principal. So John, give me a chart on here. I created this chart that shows the first 5 years of a $450,000 loan at 7% interest, which is around current median home values and current rates. And you can see that bottom bar there, the light color, is the principal paid over time. This is the first 5 years of payments. So there's 60 payments, right? 60 monthly payments. The orange is what you pay in interest. You can see most of your payment in the first 5 years goes to interest. So I looked at it, 12% of a payment on this loan would go towards principal in the first month. 88% goes to interest. After 5 years, you're still paying 17% of your payment just to principal and 83% to interest. It almost seems insane. The principal doesn't match the interest on this loan until you're 20. Now, higher rates don't help here, right? This is just a lot of it has to do with how they amortize these loans. It's a much different story at lower rates. Like at a 2 or 2.4% mortgage I was paying before, so much more of your payment goes towards principal. So a lot of this is the current environment. There's also a lack of inventory. Not a lot of people want to sell their homes right now because they're sitting on 3% mortgages. It's harder to buy because that inventory is so low. So I think you could be kind of stuck here, right? So I guess the switching costs are high. You're forced to pay realtor fees and closing costs. So I think buying a home every 3 or 4 years is just, you could time it right where the prices take off, but it seems like so much of that's going to be eaten up. You're not going to be building a ton of equity unless prices rise. And most of the money is probably going to be paid off in fees. So, I mean, I don't want to tell you sell your home now and don't become a landlord, because maybe the house goes up and maybe it's a good deal for you and you're able to recoup all of your costs. But do you really want to become a landlord? I think if you're moving around from base to base, wouldn't your life be easier if you just sold it, rented a place, and made your life simpler? And the finances certainly matter in a decision like this, but you also have to think of like the headache ratio on these choices. Like sometimes it's hard to put a price on flexibility, and it seems to me like your lifestyle requires way more flexibility, and owning a home is often really difficult to fit into that type of situation.
Yeah, it looks like we have multiple service members in the chat saying, yeah, rent.
Yeah, it sounds great to be like, oh, I'll own a rental here and I'll own a rental there, and it just sounds like a big, big headache to me, especially if you've never done this before. I think rent. Yeah, I see everyone in the live chat is saying, don't buy a house, rent it, less headache. I totally agree with that.
To be fair, it looks like the first time around worked out for them, right? 25% over 3 years gain and a low mortgage rate. So
yes.
I mean, I guess
Count
that worked
yourself
out.
lucky.
Yeah.
But yes, rent until you're in a better place and it gives you more flexibility. You can save the difference of what you'd be spending on all the ancillary costs of owning a home and buy a few years down the line. Even if prices are higher, I think it's going to make your life easier.
Cool. Sounds good.
All right,
Okay.
You got one more question?
Last but not least, we have a question from Jack. I'm 18 years old and blessed with my 4-year college tuition fully paid by my parents. I've grown a net worth of $16,000. I have a third of it in long-term, 30-plus year crypto investments made up of Ripple, Cardano, and Bitcoin. I have a third in index funds, and I use the remaining third to actively trade in the market. My goal is to be a multimillionaire and retire more than comfortably. What do you suggest my next set of steps should be? Would you critique any of my current investments? Thank you for your time. Wow, 18 years old.
18 years old is very impressive. I am very impressed. I don't think I knew what the stock market was at 18 years old. I definitely did not have financial goals besides building up a beer fund for college. Although I think when I was 18, as a senior in high school, I took all the money that I ever saved over the years from birthdays and holidays and whatever savings for any odd jobs I had, and I bought a CD, if you recall. That was my very first investment.
Sounds about right. No offense.
Yeah. But I certainly was not paying attention to shows like this or had any idea what was going on in markets or the economy. I was completely oblivious to it all. So I guess Charlie Munger once said the first rule of compounding is don't interrupt it unnecessarily. So Jack is 18 years old. Conservatively, he has like 50 years until retirement. Like, people are living and working longer, so let's call it 68. He could take his $16,000 portfolio now, not put another dime in, and compound it at 8% per year over the next 50 years, and it would turn into $750,000. So the fact that he started early is by far the best investment he'll ever make. And I must be getting older because I feel like we're giving a lot more advice to young people on this show in recent episodes. But I do have some general advice for Jack as he thinks about building wealth over the course of his life. My thoughts on the current strategy don't matter. Not going to lie, I don't really know what Cardano is still, but I'm not going to talk about individual securities here because it doesn't really matter. I think you're going to make mistakes or change your strategy many times over the years. Just make sure those mistakes are made now while you're young and then learn from them, right? Everyone pays tuition to market gods occasionally. My biggest thing is just figure out your investment philosophy and stick with it come hell or high water. That's probably the best thing that Buffett did over the years is just he had a strategy and he tweaked it, of course, over the years, but he more or less stuck with his strategy for 60 years. And that was the most impressive thing that he did. So just figure out some sort of strategy that works for you, that fits your personality. Don't worry what other people are doing. Figure out what works for you and try to stick with that. I think your career is probably going to matter more than your investments. So income matters more than frugality when it comes to building wealth, because if you don't make a lot of money, it's hard to save a lot of money. I think developing those early personal finance habits is important. It sounds like he has. If he saved up money, I don't know where the money came from. If it came from money from his parents, or if it came from him doing some jobs, but learning how to save, spend, and invest regularly is very important. I think those habits have never been easier because you can automate so much of it. I also think compounding is awesome, but don't let it ruin your life and consume your life, because I've seen so many people that will say, well, if I just invest this $5,000 I was going to use to take a vacation, in 30 years it could be worth X. And I think you still have to enjoy yourself. And the whole point
that's
of
what I was
investing,
going to say something about is the goal of just wanting to be able to retire, be a multimillionaire and retire more than comfortably. I would have a more exciting goal too, right? I mean, that's great, but yeah, have some aspirations aside from just what do you want to do with the money?
Yes.
What's the point?
Yeah, the whole point of investing is eventually you're going to spend it on something. And when you're 18 years old, it's hard to have those goals, and so those goals will change and evolve as you age. Yourself at 28 and 38 and 48 and 58 is going to be very different than yourself at 18. Myself at 43 is way different than I was at 23 in terms of my goals and what I wanted out of life, and it all changes. And I just think the biggest thing is just save a little bit of money every month in your 20s, and you will be more than set in your 50s, 60s, and 70s. So you're already on a great path. Again, just don't let the whole money thing consume you, because you're already ahead of the game since time is your biggest asset. At 18 years old, that's mighty impressive.
Also, on the crypto note, as someone who has kind of gone down that rabbit hole, a couple of times, and has lost a decent amount of money in the last bear market on a bunch of altcoins, I would just ask, the question I ask myself a lot now is there any scenario where Bitcoin doesn't outperform most of these other altcoins? And maybe you have a good rationale for why you think the answer is yes, but that's just something I find myself asking myself a lot these days is, not to be Michael Saylor or anything, but yeah, is there a scenario where it makes more sense to hold a bunch of altcoins, or are you just going to wish you'd been in the king, right? It's kind of like Apple and Nvidia versus the rest of the market kind of thing. So not investment advice. I don't know anything about this really, but just that's a question that I would think some about.
Well, it is kind of interesting that his 30-year time horizon for a crypto bet, that's longer than crypto's been around for. So
right.
Who knows what it's going to look like.
I just remember in the last crypto bull run, Axie Infinity was going crazy. Everyone was talking about it being this amazing thing. It soared and then it dropped to being next to worthless, and now it's up a little more. But yeah, it's just you've been better off just being in Ethereum or Bitcoin, one of the big.
I don't mind that he's got all these different strategies too. He's got crypto, he's got index funds, and he's got actively managed strategies, and that those buckets will probably change over time. My best advice would be just don't ever touch those index funds and keep pouring a little bit of money into them, and you're going to be well on your way by the time you're in your 40s, 50s, and 60s. You're probably not going to have to worry about money as much.
Yeah, something tells me he's going to be okay.
Yeah, at 18, I didn't
impressive.
start learning about personal finances, until I was well into my mid-20s, and the fact that there's so many avenues to do it now, not just books like when I came up. There's podcasts and Substacks and blogs and social media and all this stuff. It is kind of amazing how much easier it is for young people if they want to get into this stuff.
Yeah,
and
now you've got books like this.
I'm impressed that. Oh yeah, Jackson, email us and send us your address, and I'll send you a couple of copies of my book. That's my
Yeah.
Christmas present.
Nice.
All right. We are off until the new year. So next week is Christmas. The following week is New Year's. We're taking a vacation. Thanks to everyone for watching, listening, commenting, leaving a review, sending us amazing questions. We've still got a whole huge doc full of questions that we'll be getting to in the new year. We'll have new guest hosts helping out. We really appreciate it. Thanks to all the people in the live chat, as always. I know we've changed up the days and times occasionally. People still show
come
up.
out. Still
We
come out.
appreciate it. All the people watching live on Twitter, all the people in the YouTube comments. Anything from you, Duncan?
Spotify Wrapped. Share your Spotify Wrapped with us. We love seeing that. We have some people, we have a certain amount who we're their #1 podcast. If you're one of those people, send us an email with a screen cap, and I'm going to send you something. This is a cool bit of data from our Spotify Wrapped. 65 countries, the number of countries our listeners have tuned in from, which I find pretty impressive considering. I mean,
cool.
This is pretty U.S. centric. A lot of what we talk about. So 65 countries, not bad.
Yeah, we do get a lot of questions from people overseas. It's cool to see.
Yeah. So
So
thank you
thanks,
so much
everyone.
for listening. And
Merry
yeah,
Christmas,
we really
Happy
appreciate it.
Holidays, Happy New Year, all that stuff. And we'll see you next year.
Yep. See you, everyone.